Hello, I want to go over some of the key ideas from Chapter 2. Let me emphasize that this little video is not intended to cover all the ideas of Chapter 2. There is a video lecture available on the Connect website that thoroughly covers all the topics in Chapter 2. What I want to do is highlight some of the ideas that jump out to me uh, as being important for you to be sure you internalize. Chapter 2 is about money management skills, and this is really, in some ways, a chapter about being organized and keeping track of your finances. It's hard to know whether or not you're saving sufficiently, whether you're spending too much, whether you're in your debt, whether you're on the path to bankruptcy, unless you have some kind of financial record keeping system to have an idea of your accounts. So, with the advent of computers and now the internet, it's far easier than it was in the past to keep track of your financial records. I use a combination of paper and electronic records in my own personal financial record keeping. And for me, it's really a way of tracking my savings and investments, and also on an annual basis, keeping track of taxes paid and taxes owed. Things that you will start to think about organizing. Most of the students in the class are young and haven't started keeping track of your own records. Very quickly, you need to take responsibility for certain record keeping, things that might historically have been kept by your parents. You want to keep records of things like your employment records, tax records, credit reports, receipts for major items such as automobile, housing, and major insurance and investments. These are things you want to keep. Now, where would you store these? I think the sensible way to think about storage is there are three areas you'll store your financial files. One will be you're likely going to have either a program on your computer or perhaps on a website like Mint. It's a very popular website right now for financial tracking. That you'll have other paper things that you'll keep in some type of home filing system. I have a filing cabinet where I keep track of my records, organized myself by year. I'm sure there's other ways to organize it. I have a little file for each year. And finally, most people need to have a safe deposit box or some type of fireproof or protective safe that you can store certain documents that you really can't afford to lose. Things like birth certificates, deeds to houses, certain investment records, wills. You're really best off keeping those in some place that even if there's a natural disaster, you're going to have a copy of it. The drawback of safe deposit box is there's an annual fee, somewhere between $30 and perhaps $100 for a larger box. The disadvantage of a fireproof home safe is you have a larger upfront expense, probably a couple $100, and it's still not as secure as a safe deposit box because it's not being kept in a bank. So one thing I want to stress to everyone that goes beyond just the nature of this class, and that is this issue of identity theft. This also will be a theme that we'll come back to a couple times during the course. But when we're talking about home record keeping, things like social security numbers, bank accounts, credit card accounts, investment accounts. Eventually, you'll have investment accounts if you don't already have one. these are things that identity thieves are looking for. It's a huge issue. You need, I think, to invest in a shredder for your home. There'll be documents you'll be receiving that you're going to want to shred that comes in the mail. Um, a basic home shredder can be purchased for under $20. A more substantial home shredder can cost something up to $100. I strongly recommend that you purchase a home shredder. Begin with a small one, $15 or $20, and as your needs grow, you might buy a more substantial one. And I also want to emphasize the importance of using hard to decrypt passwords on your accounts. Your girlfriend's name, your home address, the mascot of your high school team. These are all bad passwords. You want to have passwords that are a combination of small and capital letters and numbers. Again, if someone gets into one of your accounts, you're in big trouble. So you want to not use the same password for every account. You're going to need to think of a way to keep track of passwords. But let me stress that both of those are really important. Buying a shredder so you can shred certain documents that come home from your bank that you don't want to put into your recycle bag, and you want to use hard to decrypt passwords on your accounts. A question that when you start keeping records is how long do you need to keep it? The book has a much more detailed list than what I have on this slide, but let me just mention a few of the items. There are certain things you will never get rid of. Things like birth certificates for you, your spouse, your children, copies of wills, information from the Social Security Administration. These are items that you would want to keep permanently. So you always are going to need a copy of your birth certificate. You never know when something will come up and you'll need it. Things like personal property and investments, you're going to need to keep records of them as long as you own them. Okay, so your annual statements from your investments, you're going to want to retain investments on major personal property purchases, cars, houses. You will want to hold on as long as you hold on to that asset. Documents involving the purchase and sale of real estate, again, will be something that you're going to hold on indefinitely as long as you own them, and in many cases for tax reasons for some period of time after you sell the items. Tax records you need to hold on for at least 7 years, and probably it makes sense to hold on to them for 10 years. Okay, and this is copies of tax records and all key supporting data. Things like your reports of interest and stock returns that you've declared, your wage statements, etc. You're going to want to keep these in a file along with your income tax statement for at least 7 years. Probably 10 years would be my recommendation. One of the concepts reviewed, among the variety of concepts reviewed in Chapter 2, is this idea of net worth. Chapter 2 goes over how you'd calculate net worth. Broadly stated, your net worth is your assets minus your liabilities. Chapter 2 takes time to break out items that go into your asset category and items that go into your liability category. Net worth is a measure of your current financial position. So it just gives you some idea if you or someone else were to totally liquidate everything you have, what you might have left over. What I want to emphasize is net worth is not the same as cash available. Quite often in your net worth, you will have items that you cannot use to pay for bills, for instance, like your house, like a car, like some type of long-term investment. Sorry about that. And so people often are insolvent, so this is your inability to have enough cash to pay for debts, that's not the same as saying you have no net worth, right? So you can have positive net worth, but be unable to pay your debts due to cash issues. You also can be insolvent when your liabilities exceed your assets. Okay, so insolvency can come in a couple forms. Chapter 2 goes through several ratios that you need to be familiar with. So let me just take a minute and go over these 5 ratios in this table. The chapter goes over summaries of your financial statement, okay, and financial analysts often recommend or slice and dice your data into certain ratios. For instance, the debt ratio is once you've calculated your liabilities and your net worth, you divide liabilities by net worth, and that tells you your debt ratio. Okay, and as it says over there in the right column of the table, a low debt ratio is best, right? You can have a large amount of liabilities, but if your net worth is hundreds of millions of dollars, it's not an issue. If your liabilities are exceeding your net worth, then that's probably a sign that you need to work on reducing your liabilities or increasing your net worth. Something called the current ratio is your liquid assets. Okay, so some assets are going to be liquid, that is something that you can actually pay current bills with. Your liquid assets divided by your current liabilities is your current ratio. Okay, in a current ratio, you'd like to have your current ratio be high. That gives you some cushion to pay for bills. So you might think of a current ratio of something like 3 or 4, and that would mean that your liquid assets would allow you to pay for your liabilities for, say, if the unit of time is a month, for 3 or 4 months. Okay, we often call these the current ratio. The way I think about it is like your rainy day fund, an ability to pay for liabilities. Liquidity ratio is your liquid assets divided by monthly expenses. Okay, and that would be different than liabilities, right? Monthly expenses is what you're incurring each month. Again, you would like a high liquidity ratio. The book talks about something called the debt payment ratio, and that is your monthly credit payments, things that you're paying on credit, divided by your take-home pay. Financial analysts recommend this is less than 20%. Okay, so your debt to your take-home pay is less than 20%. I showed here on the table, the book talks about this ratio in terms of debt to payment. Many financial advisors refer instead to something called debt to income ratio. Really, the difference is net versus gross pay. So the book emphasizes here this debt to payment is your take-home pay. So after you've had tax and other things taken from your paycheck, debt to income would be kind of your gross income. And finally, we have your savings ratio. So that's the amount saved each month or perhaps each year divided by your gross income. These are 5 ratios. You need to learn these 5 ratios, okay, and be ready to answer them on a test, okay. One of the things that the book covers in this chapter is how one would go about saving. Here are 3 common ways you can think about regularly saving. One is taking, every time you get a paycheck, you take money out of your paycheck and deposit it into a separate savings account. Number 2, you can use an automatic payroll deduction to, again, every paycheck deduct automatically a certain amount of money from your paycheck directly into a savings account. And third, you can just save money and make a point to spend less on certain items and try to periodically put that money into a savings account. I've highlighted the second point too. I strongly recommend an automatic deduction from your paycheck. It's really important to get into the habit of regularly saving money. You do not need to spend your entire paycheck. You should set aside some amount of money each month that you're going to save, and you're going to need to learn then to live within the remaining amount of value of your paycheck. So you might start off by saying, I'm going to save 5% of my paycheck and set aside 5% of your money. So if you get paid, let's say $3,000 a month, you're going to set aside 5% of that money, okay, and have it. Most companies allow you to directly withdraw that money and put it into some type of savings vehicle. In terms of thinking about savings, you can think of your savings as something that you have a goal. Okay, so we talked about in chapter 1 short-term, medium, and long-term goals. You should think of savings in terms of that way. You might be saving to buy a car. You might be saving so that you can buy a house. You might be savings for retirement. You might be saving so you can more rapidly pay off your student loans. Okay, so you should think of your goals and then convert those goals into specific amounts. So let's say you're saving to buy a car, so you need to save $10,000 to buy a car. And if you can set aside $500 a paycheck into savings for a new car, it'll take you 20 months approximately to save for your new car. Okay, as we learned in chapter 1, for longer term savings goals, it's important in terms of regular savings to think about the time value of money, and you're going to want to then consult the tables or the spreadsheet we looked at in chapter 1 to think about your savings amounts into what they will build over time. Those are my highlights of the main ideas from chapter 2. I encourage you to carefully review the video lecture on the Connect website and start the problem sets. Good luck.